Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. That certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is miscellaneous trivia. Today, we do have a special guest. First time on the show, John Jackson. He goes by JJ from Pacific Private Money to discuss deeds of trust. JJ, hey, how you doing?
Hey, I'm doing great, Edward. I'm glad to be on. How can I help?
Well, let's see. Okay, so in the past, I've mentioned some funds on the show that Pacific Private Money has, but let's kind of go to the basics first. Explain to us about deeds of trust and why they're considered fairly conservative for investors. Give us give us a little background.
Yeah, that's a really good question. Our deeds of trust are usually made on homes, 1 to 4 units, single family residence to 4 units. Low LTVs, about 65% or less.
Okay.
They're 1-year notes, interest only. And they're normally for people that do 1 or 3 things. They want to sell their home and buy a new home, so they use the equity to take the new home off the market, or they want to do a fix and flip, or they want to do home improvement. Those are the 3 most popular methods that people use bridge loans for.
Okay.
So anyway, it offers a lot of liquidity, at the time of close. So, it's just a real good tool to use for a short-term basis.
And generally speaking, what kind of rates are the borrowers borrowing at?
Well, they are interest only, and they are in the 10s, and it just depends on their FICO score.
Okay.
I'm sorry,
so
we do go down to.
If I'm the average person right now and I hear someone's borrowing money at 10%, I'm thinking, well, why are they borrowing at 10%? Why aren't they going to the bank? What's the reason they're not doing that?
Well, because they need the money quickly. I mean, the banks go through, full underwriting. They could take up to 30 days. We can close within a week.
Okay.
And sometimes, we're asset based. So we look at the equity in their home and maybe their liquidity as far as maybe 401ks or IRAs or long-term savings accounts that they have.
Gotcha. Okay. So I guess there's also potential advantage for the borrowers to be able to go to the seller of the house and say, hey, I can close this deal in a week or 2, versus maybe some other offer they have. And so they might be able to even get a better price on the house.
Exactly. Most escrows last anywhere from 45 days to 60 days.
Gotcha. Okay. Well, that's good. Let's see. And when we come back, we're going to go to, well, actually, we've got about a minute to go before a break. And so these loans are only for about a year. So, most typical loans are 30 years with a bank, or 15 years. So with these short-term loans, what's the objective for the borrower to pay you? He's got to pay you off within a year, does he?
Right. Well, in the first case scenario, when they're using the equity in their home to purchase a new home, while they're in transition, the primary residence sells, so they get the equity of that. They pay off the note. There's no prepayment penalty, so they can pay it off at any time. The average payoff is 6 to 8 months.
Okay. All right. So then they get either they pay you off from the sale of their house, or something happens where they can conventionally finance at a lower rate with a real bank. Gotcha.
Exactly. Normally, they're in the process of doing a Fannie Mae loan to refinance out of it. Sure.
Okay. I'll tell you what, we're going to go to our first trivia question. And as a reminder, JJ, if you know the answer, don't say anything quite yet. We'll see if you know the answer when we come back from the break. First trivia question: which luxury brand has a crocodile logo? All right. That's our trivia question. Call 888-912-1190. The first caller with the correct answer wins that tanning certificate, which, by the way, is worth over $100. Again, which luxury brand has a crocodile logo? All right. Stay with us. You're listening to The Best of Investing. Don't touch that dial. We are going to be right back. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with JJ Jackson from Pacific Private Money. Our first trivia question, which luxury brand has a crocodile logo? JJ, did you know the answer to that one?
You know, I've actually owned shirts with a crocodile on it. I can't think of the name for the life of me.
Lacoste.
Yeah.
Lacoste is the brand. All right.
Okay.
That was a trivia question. Okay, so we're talking about we're starting to talk about individual deeds of trust. Now, where do you guys at Pacific Private Money, where do you guys get your money from to be able to make loans to borrowers?
These are from private investors that we reach out to. Their average rate of return is anywhere from 10% to 11.5%, depending upon the trustee note.
Gotcha.
So they're
okay.
usually all private investors.
And are there any load fees or anything taken off that?
No.
No. Okay.
No
All right.
fees going in, no fees going out.
All right. And so if an investor wants to invest, they would believe that they would get paid back probably within a year. Generally
Right. Well,
speaking.
that's a great question. When the note does paid off, they get their principal, but they also get paid monthly interest. So the interest is paid every 30 days, once the money is wired in. So they get a automatic wire to whatever account they want the money to go to.
Okay. And I assume, or I'm not going to assume, I'm going to ask you, can people invest through their retirement accounts?
Yes, they can.
Okay, that's good. Can you talk about the risks?
Well, we the foreclosure rate is really low with us, and since there is so much equity, the average LTV is 65%. And
Okay.
I'm assuming people understand what that means, loan to value.
Okay.
So we're able, if it were to go south, let's say, we're able to recover because we have 35% of equity, so we can restructure the loan or even resell the note, to other investors as well, or to another private individual, or just to sell it to an institution as well. It just depends. But I mean, I've been here for 3 years now doing this, or almost 3 years. Not one foreclosure.
Wow. Okay.
Not one.
Yeah. Also, it's interesting. You don't really have too much of of course, your guys are paying a good interest rate anyway, but you don't have much of an interest rate risk because the loans are fairly short term.
Correct.
Yeah. And if the 1 year, let's say the 1 year comes up and the borrower's paying, but they can't pay off the principal, can they extend the loan?
They can. In certain situations, we extend for sometimes 3 months, sometimes 6 months. Again, it depends on the individual borrower,
Okay.
and how they look, and, just the circumstances. So we're not going to cut people off.
Gotcha. And so taking like a 30,000-foot view, trying to think about the risks on this, as long as you're doing decent underwriting on the loan itself, on a 1 year loan, properties would have to drop more than roughly 30, forgetting fees and stuff like that, to cost of foreclosure. Right. The properties would have to decline at least 35% for someone to actually lose their principal.
Exactly.
Yeah,
so, yeah, and so we're able to recover if it were to happen, but because there's just too much equity, people do not walk away from that. They don't walk away from their equity.
It's interesting because even during the Great Recession, there were a lot of people who were underwater, but they didn't want to lose their home, so they kept making payments to quote the bank. So you can even kind of ride out that storm too.
That is true.
Yeah. It's funny. I have some individual deeds of trust, and it was literally last night. I had done a loan a few months ago, and it looked like it was a good loan. And the person made the first payment, and then their second payment's coming up April 1st, and I get an email saying, "I wonder if I can pay a portion of the principal." And I read that to mean, they're not going to be able to make the full payment. They want to make a partial payment. And so I wrote back and I said, no, unfortunately, I really do need you to make the full payment. And she wrote back and she said, "Sorry, Edward, I didn't make myself clear. I'm going to make the regular payment. I just want to pay extra principal so that because the interest rate's fairly high." I said, "Oh, okay." And she just wanted to make sure that there was no prepayment penalty. So I said, "Oh
Right.
yeah, no prepayment." Yeah. In fact, we've got about another minute before a break. Are there any prepayment penalties for the borrowers on your loans?
Excellent question, Edward. No, there are no prepayment penalties at
Okay.
all.
Yeah, because again, if you're a good borrower and you have extra cash flow, even within that first year, you go, gosh, if I'm going to have to pay at over 10% rate of return, it's like a credit card, like at a low rate. I want to pay those off as fast as possible.
Yeah, our
Right?
average FICO score for people to understand is about 733.
Wow.
So A plus borrowers
Yeah.
on average.
It's
So
it's mostly speed is the main reason that most borrowers go.
exactly,
Okay.
exactly.
And let's see here. Okay, well, we're gonna tell you what. We're gonna go to our next trivia question here. Before I do want to make a mention here for the San Francisco Bay Adventures. For over 30 years, they've been the premier boating event and tour resource for the San Francisco Bay for private events such as birthdays, weddings, and smaller groups or individuals can also buy tickets to public tours such as Sunday morning wildlife sales under the Golden Gate Bridge. Visit sfbayadventures.com or email info@sfbayadventures.com. Tell them that you mentioned or that you heard this on the Best of Investing to book your adventure. And our second trivia question, and again, JJ, as a reminder, don't say anything yet. We'll see if you know the answer when we come back. What color are the sunsets on Mars? I guess we should probably ask Elon this because he wants to occupy Mars, right? Call 888-912-1190. First caller with the correct answer wins that tanning certificate. What color are sunsets on Mars? All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We are going to be right back. Welcome back to The Best of Investing. Edward Brown here along with JJ from Pacific Private Money. Our second trivia question, what color are the sunsets on Mars? What do you think, JJ?
I would guess either red or orange.
That's what I would have guessed too, but they're blue. Isn't that
Really?
crazy?
Oh,
Yeah, that
that's
was
fascinating. I never would have guessed that.
I never would have thought that. Yeah, it's like we get the blue skies here, man. I don't know. Maybe a bunch of clouds go over there and they get the blue sky. I don't know. Okay, so we're talking JJ. We're with JJ from Pacific Private Money and Individual Deeds of Trust. If any, let's say someone does buy an individual deed of trust and something does happen, are they on their own, or do you guys help them go through the foreclosure? Do they get their payments during what? Because you guys aren't guaranteeing anything.
Yeah, we help and advise, if it goes to that. But again, I've been almost doing this for 3 years for Pacific Private Money. Hasn't happened. They're just really strong borrowers, really good low LTV. Another thing we do as well is we cross on other properties. In some cases, we cross on 2 or 3 properties. So that means that we have equity in 3 additional properties or 2 different additional properties. And again, with the FICO scores where they're at, they're A plus borrowers. People are not going to walk away from
Gotcha.
their individual interests in their properties.
Now,
Now we also,
go ahead.
I'm
Go
sorry,
ahead.
we also have what's called the Freedom Fund. And the Freedom
Okay.
Fund, if people don't want to buy individual trustees, the Freedom Fund is made up of bridge loans that are made and sold to individual trustee holders. So if they'd rather have us manage the whole thing, then we do that. So we put it in the fund, and depending on the level of investment, they get paid anywhere from 8% all the way up to 10%, depending on the level of investment into the fund.
Okay, so I guess the better part of that is the fact that they get diversification.
Exactly.
Gotcha.
Exactly.
Okay.
And so they don't have to worry about rolling over their money once some of the notes pay off early, into another note. But some investors really enjoy that. So, but I just had one last week that just said, well, a few weeks ago, I said, no, I'd rather have you guys manage it. So do you have a fund? I said, absolutely. We have a Freedom Fund.
Gotcha. Okay. And before I forget, how do people get a hold of you if they are interested in anything that Pacific Private Money offers?
Well, they can call me on my direct line, which is 949-500-6931. That's my business line. It's always with me. You can even call me after hours. I allow investors to do that. So I take calls on Saturday and sometimes Sunday nights. It's not a problem.
And then sometimes people just like to email. What email can they reach you at?
It's a really email address to remember. It's JJ. My name is John Jackson, but all my friends call me JJ. So it's
Okay.
JJ@pacificprivatemoney.com.
That's pretty easy. The letter J at pacificprivatemoney.com. Okay, good. Let's see here. So now where would, I'm just trying to think, if I'm the average borrower, I probably have never heard of Pacific Private Money. So how do borrowers come to you from a borrowing standpoint? How do they know about you?
Well, they normally visit through the website, but we also do email campaigns where we email out individual trustee notes and also about our funds. And so a lot of
Okay,
it's done through
that's from
advertising.
that's from the investor side. I was thinking from the borrower side first. Like
Well, the
if
borrower side,
yeah, how would borrowers even know about you guys?
they would, well, then go to pacificprivatemoney.com.
Okay, but I guess what I'm getting at is how, like, let's say let's say I want to buy a home and I want to make an aggressive offer and I want to I realize that Wells Fargo is not going to be able to help me because I want to close this deal in 2 weeks. How would I even know about Pacific Private Money?
Well, that's a good question. The only, the only thing I can say is most people contact me via email and through our
Okay.
website. So it's kind of hard for
I
me
guess I guess
to.
bro- I guess brokers know about you guys.
Well, of course, yeah, we deal with hundreds and hundreds of individual mortgage brokers. And
Gotcha.
in fact, one of our larger brokerages called Groves Capital, based out of San Diego, and they have over 500 loan officers. Who we also um, have a C2 lending, which is based out of San Diego as well. I don't know why they're all based out of San Diego, but that's the case. And they have
Yeah.
over 1,100 loan officers.
Wow.
So, yeah, so we advertise to many brokers nationwide and many through California, even Northern California in the San Francisco area and all the
And is
surrounding
there
counties.
before we have to go to break, because we have one more break coming up, is there much competition for you guys?
You'd be surprised. There's not.
Okay.
Not a lot of people even understand bridge loans.
Yeah.
They're only exposed to it by either a really educated loan officer or they've had experience before.
Interesting. Okay. Let's see here. We do want to go to our next commercial break here. Uh, this one, I had never even heard about this. Okay. What is the cheapest grocery store chain in the U.S.? And I guess I don't know if they do it by, average prices or something. I would have thought it would have been Walmart, but apparently that's not the correct answer. All right. Call 888-912-1190. Again, the first caller with the correct answer wins that tanning certificate, which is worth over $100. What is considered the cheapest grocery store chain in the U.S.? All right. Stay with us. You're listening to The Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to The Best of Investing. One more time, I'm Edward Brown, your host, along with JJ from Pacific Private Money. All right, JJ, let's see if you know the answer to this question. What is considered the cheapest grocery store chain in the U.S.?
Well, I would probably say Stater Brothers or Piggly Wiggly.
I've never even heard of this one. Aldi? ALDI?
I've never heard of
I've
Aldi.
never even heard of them. Maybe they're from the Midwest or something, but
Yeah, they've got to
apparently
be from the South or back East.
they're
Yeah,
South
who
Texas.
knows?
Yeah. All right. Well, you're 0 for 3, but that's okay. We still love you anyway.
Fun
All right.
questions, though.
Yeah, they're kind of very sporadic there. All right, so we sometimes like to talk about a deal of the week. So give us a few examples of actual loans that you've been involved with, where investors, could have potentially, if they would have known before you sold them to other investors, they could have gotten a hold of you.
Well, exactly. Well, right now we have a note available in your area, actually up in the San Francisco area.
Okay.
It's a $616,000 loan, which you can invest on a fractional basis. So the minimum investment we'd require is $61,600.
Okay.
and it pays 10%, which is APR, annual percentage rate, and the
Okay.
interest is paid monthly. Now, these notes go very, very quickly. And this note actually sold. I just put my last investor in this note, and it sold within 4 days.
Okay.
Because some of our notes, I mean, this one is at 70% LTV, but we had a note just the other day that sold in 2 days. It was 6% LTV.
6%. What were the numbers involved on that?
Oh, I know you're going to ask me that. I don't
Yeah.
have that in front of me,
I mean, a
but
six.
it was
I'm thinking of like,
yeah,
someone's
it
got a
was
million dollar property, they need 60 grand.
no, it was a small note. It was only $100,000. It was a small note, 100,000. But
And
the person just needed some additional cash to do some home improvement, and it was 6% LTV, and they just needed it for a short-term basis rather than getting a warehouse line or credit, not a warehouse line, but a equity line of
home equity,
credit,
right?
which takes usually another 30 days or close to 30 days to get that approved. And so, we did that in just a couple days, so it didn't even take a week to approve that loan. So,
Yeah, I guess, that's the thing is if you need like $100,000 really quickly, sometimes it's just worth it to pay a little bit more than go through the hassle of working with a bank. If you guys
well,
your
yeah,
underwriting is pretty simple.
your equity line of credit rates are pretty high as well. They
Yeah,
are
that's
interest
true.
only like ours, but the equity line
Yeah.
of credits are very high interest rates as well.
I wonder what they are nowadays. In the
You
sevens,
know,
percent?
it depends on the FICO score. It could be anywhere from the low sevens to up to 10, 11%, depending upon FICO.
Wow, I haven't seen like a bank do an 11% HELOC for 30 years.
Well,
With the
it just
interest rate.
depends. It depends again on the borrower, and the equity position. So the lower the equity and the lower the FICO score, the higher the rate.
Gotcha. Okay, so Pacific Private Money, they do these typically the bridge loans, and very low foreclosure rate. And you guys are paying a pretty high rate of return. Now, there's no prepayment penalty to the borrower, so the investor might be in a loan, and then 3 months later they might get paid back.
Right. The average payoff is 6 to 8 months.
Yeah.
And I always share that with the investor, uh, as they call in. I let them know that sometimes it goes 12 months and sometimes it'll even go 18 months. Just depends
Yeah.
on the borrower and the terms. But the average payoff is 6 to 8 months.
And what kind of file does does an investor get to see? Because it's one thing to kind of hear you verbally tell them, this is the address of the property, this is the loan amount, et cetera. Do they get to?
That's an excellent question, Edward. Excellent question. They actually get to see the underwriting file. So as an investor, they do sign some forms to keep it all private because they are going to see some personal information from the borrower,
Yeah.
and they're going to see the underwriting file. In some cases, we have an appraisal in the file for them to see. So they get to see the credit report. They get to see everything.
Okay. Now, when you do a loan, let's say to a borrower at 11%, and a client invests, you guys must take some kind of a servicing spread, I would think.
Yeah, we do. We actually service the loans. So, we might go out if it's an 11% rate that we're paying out, we're lending out at 12, 12 and a half,
Okay.
and so, we make our money on the spread.
Gotcha. Okay. And then do the borrowers also pay points on these loans generally?
The borrowers do, yes.
Okay. I guess if a broker brings it to you, you might have to share some of the points with the broker.
Oh, absolutely. Yeah. The brokers have a set fee that we pay them.
Gotcha. It's funny, and I was thinking about this, if you're doing loans at, let's say, 65% LTV, so let's say it's $1 million loan, or excuse me, $1 million house, and you're lending 650,000. In theory, if anything goes wrong, and the borrower, or then let's say the investor takes the whole thing, in theory, the investor might make a lot of money.
Yes. And that happens. That happens.
Yeah. I mean,
We have investors that are liquid. up to $1 million. I just had one of my investors that bought 2 notes to put his $1 million to work.
Wow. Okay. Pretty wealthy guy. If I had his money, I'd throw mine away. All right, JJ, before we cut to our next break, go ahead and give out your information one more time, would you?
Again, you can reach me on my email at jj@pacificprivatemoney.com, or you can reach me on my business line, which is 949-500-6931.
All right, audience, stay with us. The Best of Investing will be right back with some closing comments. Don't touch that.
Talk about what?
Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with my special guest, JJ from Pacific Private Money. With no trivia question on this one, but JJ, comparing funds to individual deeds of trust, you mentioned that the fund it's almost like a mutual fund, I guess, because they'll have diversification of loans. What are the risks to the funds versus individual deeds of trust?
Well, again, our foreclosure rate is almost nil.
Okay.
The fund, you're investing in all the loans. You have a percentage of the fund, which covers all the loans. So the Freedom Fund, for example, is a $90 million fund.
Okay.
And when I originally started with Pacific Private Money, it was in the 50 range, 50 million, 55 million. So it's grown to 90 million. And so you're completely diversified in all those notes. And we have a servicing department. We have people that follow the payments religiously and, that protect you and protect the fund. So it's just a little bit more of a secure, in my humble opinion. Even though the trustee notes, in my humble opinion, have never gone south, but the fund it's an ease of mind. You don't have to worry about an individual property. You don't have to worry about location or LTV or looking at a file. You just trust our people in the office and the underwriters and with the average FICO scores of the 700s that they're going to protect your interest.
So it's more of a passive investment. So if there is a foreclosure, the investor doesn't get called. It's
they don't even see it. They don't even see it.
Gotcha. Versus an individual deed of trust, if there's a foreclosure or a problem with the property. I mean, I had one time where literally I didn't get paid on the loan for 2 years because the borrower went in and out of bankruptcy 3 different times.
Ouch.
Yeah. Now, as it turns out, there was enough equity in the property that even with my legal fees and my late fees that I had to add and all that kind of fun stuff, I still didn't get hurt. So it was just more a cash flow issue of, oops, I didn't get the payment from the borrower. So, there's pros and cons to both. Some people like it. Yeah, go ahead.
Did you do that individually?
Yeah. Yeah. So fortunately, I had other deeds of trust that were paying, so I didn't have to. Otherwise, it'd be like, how am I going to pay groceries for the week? So that's one of the things. Again, you don't want to be so overloaded on one deed of trust. Are there any qualifications for being in the fund versus individual deed of trust to qualify?
Yes, in the fund, you have to be an accredited investor, which means that you have to have $1 million net worth and make at least $200,000 to $250,000 a year for the last 3 years.
Okay. And individual deed of trust, do you need any qualifications on that?
If you're out of state, you need to be accredited, but most of our deals are in California. So California investors have no requirements. These have to be what we call sophisticated.
Okay. And what's the qualification for? Is there any qualification of sophistication?
Well, a sophisticated investor usually makes a 6-figure income. Has about $50,000 in the bank on average. Okay. So they're considered sophisticated.
All right, fair enough. JJ, thank you so much for being our guest. Are you ready for our thoughts for the day? These are always kind of fun. So I bought I bought a new deodorant yesterday, and the instruction said remove cap and push up bottom. Now I can barely walk, but whenever I pass gas, the room smells lovely. and and I was going to tell you about a time traveling joke, but no, you didn't like it. All right,
I
tune in
didn't
next.
expect that.
Yeah, you didn't expect that one. Okay, audience, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.